Okay, Sam, you've been interacting with project stakeholders from all over the world and also reviewing sample financial statements that people have sent us and that are available on our website. You must have seen a really interesting range of presentation options and different types of challenges that people have experienced. Can you give us some examples of those?
Sure. Well, as you said, it's been a real privilege to talk to different people and see such a range of approaches that have popped up all over the world. So I thought I'd prepare a simple set of illustrative financial statements prepared in different ways that could help frame our conversation. I should mention that these are common existing practice around the world, much as it's not exhaustive, but they're not the alternatives that are being presented for the guidance, which is what you'll be sharing with us later. So here it is.
So we have the basic structure of any financial statements as the story of what happened between 2 points in time. So the opening and closing balance sheets here are made up of the 3 core elements: assets and liabilities, and then that third box could be called funds or equity or net assets, whether they're presented vertically or horizontally. Then we have the story of what happened during the year in financial terms as income and expenditure. So as well as general income that can be used for anything within the organisation's objectives, some income comes with stipulations, whether they are restrictions or conditions or performance obligations. Now, we covered that in some detail in our webinar on the 21st of July. So without getting into all those details, I'm just going to use the word limited use or the term limited use to cover all those ideas. So for this illustration, let's imagine the organisation generates general revenue of 20 and spends 19 of that. It also gets revenue with limitations of 150 and spends 100 of that, with the balance of 50 to be spent the following year. Then if the opening funds are 10, you'd add on the 51 and you'd end up with 61 at the end of the year. So that's one way of presenting it, but there are lots of other ways to present exactly the same information. So here we have the 2-column or multi-column presentation. You could also just have 1 column like that. Sometimes income and expenses are transferred from restricted to unrestricted as conditions are met, like this. Then, depending on the accounting policy, income with limitations could be deferred like this. So here's the 50 unspent income, so that it appears in liabilities section of the balance sheet. And then you'd have that could either be in a single column or a multi-column presentation, either way. And then the movement in funds would be starting with 10, adding 1 and ending up with 11. And then finally, there's this T account presentation, which is common in India and elsewhere.
So Sam, it's really great to see those illustrative examples side by side, and I think it helps to frame the conversation. And whilst, as you say, it's not exhaustive, I'm sure people will be able to see something in what you've just described there that they're familiar with. So let's just focus in a bit. I'm interested to hear about any particular challenges in presenting revenue that is not freely available. Perhaps you can talk about that.
So I have heard of cases where board members or community members have seen, a large bank balance or a large surplus number, and they've drawn wrong conclusions. And it's really important that it's clear those funds aren't freely available. Then in many countries, if tax authorities see unspent income presented as a surplus, that could be interpreted as if it's a taxable profit. And that's a really strong motivation for NPOs to want to present unspent income as a liability. But overall, I noticed generally a strong tendency for people to prefer whatever presentation model they're used to from Colombia, USA, Europe, Middle East, and India. But interestingly, there was general agreement that most of the information needs can be met if there's adequate additional analysis in the notes, irrespective of the overall presentation that's chosen.
Well, that's a good start point in terms of that kind of consensus. Still on the theme of income with limited use, Have you come across particular challenges related to the presentation of donated assets or grants for assets?
Yes, lots of challenges. I mean, I might even think this is one of the biggest challenges, and certainly the single greatest reason why cash accounting is so prevalent in the non-profit sector globally. Obviously, if a donor has paid for an asset, they want to see the cost of that asset as an expense. They're not really interested in depreciation. So we see many NPOs expensing donor-funded assets to meet their donor reporting needs, even if that's not in line with accounting principles. In East Africa, where I live, it's common for NPOs to first expense an asset from the donor fund and then capitalize it by crediting a capital fund. This some problems, but it creates other problems. And I've got a lovely short clip here from Erastus Omolo. He shared 7 challenges he experiences with donated assets. I'm going to play just 4 of them for you here, which are numbers 2, 3, 5, and 7 on his list.
2. Disclosure in the financial reports where assets have already been expensed. 3. Treatment of own acquired assets and donated assets within the same set of financial reports. Conflicting policies occur when one is expensed and the other is capitalized. 5. Matching principle. Spread of utilization of the cost of the asset is restricted. Expensing assets in year of acquisition, yet the project duration is longer. And 7, which is my final point, is the problem of double counting when we expense and at the same time pick up the cost of the asset and depreciate the same on the face of the balance sheet. Again, it leaves us with an issue there. Thank you.
So we heard Erastus there referring to the matching principle, which was a fundamental accounting concept when many of us were training and taking our exams. And it still feels a really intuitive way to think about the income statement. I myself only learned relatively recently that this matching principle is no longer at the heart of the IASB conceptual framework. Karen, what happened there?
Yeah, Sam, let's talk about that, because I think it is it comes up time and time again. So the IASB conceptual framework was amended in 2018, and that included new definitions of assets and liabilities. So income as part of this new framework is defined as an increase in assets and expenditure as an increase in liabilities. And often that results in the same outcome as using what was the matching concept. But it means that in some cases income is deferred, and that deferral type approach, while it might feel intuitive, is in line with the conceptual framework. This is clearly something we're going to have to face as a project, as I said, because we hear about it time and time again. We've also been hearing time and again in our outreach about how donors are a really important set of stakeholders in our context. Have you had any feedback about how useful general purpose financial reports are for donors?
Absolutely, lots of conversations, but I'd love to share this video I have from Barbara Schneider-Gibitz in Austria, concluding rather discouragingly that many of their donors are largely indifferent to the efforts that they put into their general purpose financial reports.
We are a global disability and development organization which raises funds in Europe and the US and implements projects primarily in sub-Saharan Africa. Let's look at the private donors first. In my experience, they do not really bother to look at our financial statements. Maybe it is too time-consuming if it is only about a smaller donation. Maybe the presentation is too technical. Most likely, however, the donors rely on the Austrian donations quality seal which we hold. To put it short, our financial statements are basically useless for the majority of our donors, who account for more than half of our donations. This leaves the other half of our funding, which comes from major donors like foundations and public bodies. The first step in the process is to win a grant, but the financial statements are not really helpful in this respect. It goes without saying that we want to appear as cost efficient as possible, which in our world translates into specific ratios between program expenses on one side and administration and fundraising expenses on the other side. However, it is next to impossible to extract this information from our financial statements, even though we are fully compliant. And what about our donors who require reporting based on cash accounting while we need to stick to accrual accounting? Even the simple down payment in one period with a corresponding expense in a consecutive period can cause enough problems, not to mention capital assets. To summarize, our financial statements do not really meet the needs of our donors. We have to invest a lot of extra time and effort to meet different donor logics, but most of this work, unfortunately, is useless for other purposes.
On a positive note, we have convened a donor reference group that includes the World Bank, USAID, FCDO in the UK, the Global Fund, and a number of other foundations. And we're receiving input from them, even as we speak, for their suggestions on how general purpose financial reports might be presented in a way that could really be useful for them. And this could potentially reduce the burden of due diligence and multiple audits moving forward.
I mean, that's clearly really important from the project's perspective, and encouraging that that is in place. So look forward to hearing more about how that's progressing as the project develops. Moving on to think about reserves, have you heard about challenges associated with understanding reserves?
Absolutely. I know that, for example, for some of the foundations that Humentum has worked with, we've been training desk officers who review the financial statements of potential grantees. And this is something that they're really interested to understand as part of their due diligence assessment. Depending on how reserves are defined, that might be the number 11 in that example, that those illustrations we shared earlier. But often it's not easy to find that number in the financial statements. And what if the number was 3 or 500? What's the appropriate level of reserves for that organization? And do they have less or more than they need? It could be really useful to see that in the narrative report. I spoke to a consultant who'd worked with many NPOs across the Middle East, and he explained that nearly 100% of many organizations, 100% of their income comes from grants with use limitations, which of course is really common across the sector. In this one case he shared with me, the managers and the board had never really stopped to think about building reserves, just because it seemed so impossible. But nearly a year later, 2 of their major donors pulled out and the organization folded, which is just such a shame. Interestingly, what we're seeing for some more progressive donors is that they're actually giving grant funds specifically to enable organizations to grow their reserves. I think that's a really interesting development we're seeing now.
Yeah, no, absolutely. That's fascinating. I think the non-profit motive sometimes makes people think that it's not appropriate to have reserves, but organizations need to be resilient. So I think it's a really important issue, and perhaps should have more focus in the sector. So really good to hear about those. Now finally, let's look at narrative reports. What issues have people shared with you about narrative reporting?
So for those countries that don't have detailed guidance, one of the key challenges is how much detail to put in. And we see everything from a minimal single page focused on, Companies Act requirements. For see something like the results of the year 1, which doesn't really mean anything at all in an NPO context. And then at the other end of the spectrum, there are narrative reports with fabulous 80 pages of glossy photographs, indicators, targets, achievements, quotes and stories. Really, really wonderful investment of time. But with so many pages, it can be hard to see the wood for the trees sometimes. And you might have lots about achievements, but maybe not so much risks or governance. So I think the key challenge is that balance, isn't it, of having enough of the right kind of information that will really add value and be relevant to a wide range. Balancing that with that creating too much of a huge burden on preparers. That's the challenge I see. Absolutely,
and that sits at the heart of this project, balancing the needs of different stakeholders and balancing that with preparers as well. You know, that's one of the key objectives that we have in developing the guidance. So Sam, thank you for sharing those examples. I think it helps to bring this issue to life for us and hopefully really good context for the rest of this webinar. So thank you again.